Good afternoon, everyone. Welcome to today's edition of the Insig News Speaker Series. Today, we are joined with Gabriela Santos. She works directly at JP Morgan Asset Management. For those of you who have not seen her or have not had the opportunity of interacting with her before, and the idea of today's conversation is to make it very conversational, let me be redundant, in which I will start asking you a couple of questions. And please, I ask the audience, if you have any questions, drop them in the chat so I can ask Gabriela afterwards. In general, what we'll do is talk about the economy, what it implies going forward for this remaining months of the year, and her views and her takes in general. So without further ado, first question. Gabriela, in your opinion, do you believe that inflation has already peaked in the general overview of the world?
Well, thank you, Melissa. It's good to be here chatting, and thank you, everybody, for your time and your questions, hopefully. So I think it kind of depends where you are in the world. I think there's good reason to think that in the US, inflation probably did peak back in June. And we did see slightly softer inflation in July of 8.5%. So slightly softer, but a little bit better. And we think August CPI, which comes out next week, will be even a little bit softer than that at 8.1%. So the reason we say that is we continue seeing a big fall in gasoline prices, which has happened for 85 days now. So that's a big weight off of the headline CPI. Food prices also came down in August, so that's another relief for the headline. And then for the core, we continue to expect some slightly softer auto prices and goods prices as well. Now, that's the US. I think for a large swath of EM, perhaps the peak was in July, and we should see in August that better effect of lower food prices, which has a bigger weighting in the emerging market basket. And then lastly, if you're in Europe, unfortunately, I don't think inflation has peaked and won't peak until the fourth quarter, maybe even early next year. That's because of really the fact that they're at the epicenter of the geopolitical conflict in Ukraine. And we continue seeing a big rise in electricity prices and natural gas prices there. Overall, though, I think we can probably say for the US that we're past the worst. I think the question is more just how quickly inflation comes down from here, especially when we think about the core of inflation, things like housing prices, services prices. It might take quite a long time for that to really get back to normal.
Definitely. And actually, considering that rhythm that you just stated of the headline, both the headline and the core inflation, that it will take them to go back into what the Fed has denominated the preferred target range for inflation, or even target measure. Do you think that, given what you just stated as a backdrop of inflation, will we see a rate cut coming from the Fed the next year, or do you believe that we're just starting in terms of hikings?
So I think we've done quite a lot already, right? We've already hiked rates from basically 0 to 240 basis points on the midpoint. So I think we've done quite a lot, but very clearly the Fed is saying we're not done quite yet. It's nice to have had a month, maybe 2 months if August CPI does come down, but it's still way too high. And we don't forecast inflation to come back to normal until really through 2024. So they feel like they've taken rates to neutral. They now need to take them into restrictive to make sure that inflation does continue coming back to normal. So we do expect a hike of 75 basis points on September 21st, a little less than 2 weeks from now. Then probably another 50 in November and a final 25 in December to get rates around 4%. I do think, Melissa, as you say, the questions for next year, will inflation come down quickly enough and convincingly enough that the Fed feels like it can cut rates at some point next year. I think the market back in June, July was thinking, yes, definitely. And there was that narrative of a dovish pivot and rate cuts being priced in already in the first quarter of next year. And it led to this kind of summer rally in the equity market. I think the Fed at Jackson Hole very, very aggressively pushed back against that and said, stop, that is way too premature. The path lower for inflation is going to be a long one. We're not talking about rate hikes at the moment next year. But that's really the question. That's what keeps volatility high in the bond market and by extension, the equity market for a bit longer, while investors try to grapple with how quickly inflation comes down and what that means for rate cuts next year. And the truth is no one knows quite yet.
And market has already proven us several times that the moment that you believe that something is going to happen, exactly, it goes the opposite way. So trying to predict and trying to assess the next move, it's always a very daunting task. No, go ahead, please.
Oh, I was just going to say, especially because this is a different Fed. We keep trying to think that they're the old Fed. No, they care about growth. They're going to be there to support the economy and they don't want anything bad to happen. And they're worried about the stock market volatility. That was the old Fed. That worked really well for 12 years. But that is not what's happening now. This is a different Fed, very worried about inflation. A bit late to that worry, but now worried about it. And they've told us explicitly that they're willing to tolerate pain in the economy.
That is very
so
true.
The strike price for a Fed put is much more expensive than it was before. It's going to take a big slowing in the economy, a big move higher in the unemployment rate to get us those rate cuts that investors really, really want.
So following that train of thought, we're both aligned in the thought that inflation will take a longer time than expected before to come back to desired levels, and that this is going to dent on growth, be that allowed by the Fed or not. Do you believe that under that scenario and under that light, what are the odds of getting a soft versus a hard landing for the next couple of years, mind 2023?
Yeah, so I think especially if we think about later this year, early next year, you still have high inflation, right? That still eats into incomes and spending. You still have rates moving higher and potentially staying at these restrictive levels. So it continues to weigh on interest rate sensitive sectors of the economy like housing. And some business investment as well. And then you have some other drags in the economy like the shrinking budget deficit, the strong dollar, kind of put all those ingredients together. And what spits out is still very elevated recession probabilities. Now, you can't say a recession, the fourth quarter, first quarter is guaranteed, but it's still a more elevated than normal probability because of these dynamics. And we would put it really at this point at 50-50, whether the Fed is able to engineer a soft landing or a period of just low growth, but still positive, or if it ends up tipping into a contraction. And that's why I think you've seen a lot of that summer rally fade because, right, we can't really add risk at this moment with a bet that there will be a soft landing because the Fed will change course. We're just not there yet, right? We need a little bit more information to feel comfortable adding risk and the market to start that longer term rebound we know will come eventually.
Okay, so I actually have sort of like a corollary to that statement you just made. You said that you're not feeling comfortable adding risk right now to your portfolios, which makes a lot of sense because, as we just stated before, the odds of a recession are very 50-50 going forward. So do you feel then that, I understand that not adding risk, but would you feel comfortable overweighting stocks and credit again, given the current backdrop, or what is your current strategy in terms of asset allocation?
Yeah, so that's what we mean not adding risk in the sense of not moving back to overweights. So still maintaining an underweight to equity makes sense to us, as well as a preference for higher quality fixed income over something like a high yield credit. Now, I think when the message is discussed with clients, right, that can be a more nuanced conversation because we're talking about, right, tactical allocation at the margin of staying underweight. We don't want that message to get extrapolated into just sell everything then and we'll call you back when everything is great and we'll restart building all the exposure to equities and high yield then. So that's just when you're speaking to clients, I think we're all, of course, very aware that there needs to be a finessing of that message.
Of course.
Because ultimately, we know the market is going to rebound once again, especially the US stock market. It never fails to recover a previous high and more than surpass that high. We spend the majority of the time in a bull market. That's where we generate the majority of returns. And it's going to be impossible to time that perfect turning point completely. It's more of a tactical at the margin kind of discussion.
Okay, that makes sense. You can definitely say if you don't feel comfortable answering this question, but in our previous monthly commentary, Ahmed discussed that he personally felt that the moment to overweight European equities was coming sooner rather than later. Because this is sort of like a divergent point of view with a lot of people actually being more underweight European equities than the rest of the market. So do you agree? Do you digress? What's your take on European equities right now?
That's such an interesting point because I think this week there's been so much angst about global growth in Europe because of the energy crisis and the pressure that's putting upwards on inflation, downwards on growth. I think the recession probabilities we discuss in Europe are much higher than they are in the US. It's basically the base case. And then we're just discussing how deep or shallow that recession will be.
Of course.
And that will end up depending on whether Europe has to do actual energy rationing or not. In terms of the moment to overweight European equities, I don't think we're there yet to say, let's go all in on Europe and go overweight, both in terms of the local market as well as the currency, right, which is still under a lot of pressure, the euro.
To say the least.
And to say the least, exactly. 20-year lows below parity, send money to Europe, go to Europe now. As a US investor, it can be a bit tricky to make a big case to go overweight now. But I think to your point, the turning point is probably coming sooner rather than later, because there already is a lot of pessimism about all these things that we're discussing. You already have very depressed currencies, very depressed valuation multiples, both in the Eurozone as well as in the UK. So it's also not the time to go sell Europe, right? That moment's past. And if a client doesn't have any exposure to Europe whatsoever and is already super duper underweight Europe, then slowly I think it's the time to build some exposure. So it all depends on the starting point. The thing I wanted to mention, especially when times are so uncertain, I think more than just like, do I have it? Do I not have it? It's more how you take risk that's important. So what you buy when you're investing in a market. So for Europe, that's especially the case of focusing, I think, on some of the things that Europe does well in terms of structural themes. So things like they're really leading here in terms of renewable energy. They're really, really leading in terms of their exposure to the emerging market consumer versus the US. And they're also very much leading when it comes to certain topics related to industrial automation. Some very exciting things are happening in Europe. It's just not a cyclical macro overall index overweight call. It's more of a slowly building exposure to these structural.
A little bit like cherry picking amid a sea of turmoil, which in the end
Yeah, it's not buying the Euro Stock 600 stocks. It's buying the cool stories in there that are now trading at discounted valuations and that are probably closer to turning around, given all the negativity that's already in there.
Yeah, I completely agree with what you're saying, that the worst part of the crisis is already priced in assets, even if we have not seen it yet materialized in indicators or even in inflation peaking or growth decreasing as much as it can go. Slowly and quickly returning to the US, which I guess would be one of my last questions on the US. We have seen throughout the whole year the strength of the US dollar. The Latin American currencies have felt it, the euro to say the least, as we were saying before. So do you believe that this dollar strength is going to remain for a longer time? Do you see the dollar at some point weakening? What's your take on currency specifically?
I think there's all the action is happening these days in the bond market and the currency market. It's not even the stock market. If you look at just the volatility of these different asset classes versus what's normal for them and who's kind of driving the action, I think largely in FX, with the exception of the Japanese yen, I think all the other currencies are being driven much more by a flight to quality to the US dollar. Yes. Driven by global recession concerns. I think that's what's happening with the euro, with the pound, with EM currencies as well. I mentioned the yen as an exception because the Bank of Japan is the only one that's not going to raise rates ever again. And it's just such an extreme interest rate differential. And investors seem to be really taking some speculative bets right now that's not going to change. But every other currency, I think it's more about angst about global growth and flight to quality in the dollar. So I think as long as that angst persists, you can continue seeing a strong dollar. But we know that's not forever, right? Eventually, we'll have priced in everything bad that can happen, and then things start getting less bad. And then investors really start going back to these other markets to capture discounted valuations and a turnaround in performance.
And especially the carry trades and the interest rates are going to start looking so attractive outside of the US that it's going to be almost a bargain for investors, like to try and go to markets that had not been explored before. EM rally again.
I think so. And I think what's interesting, actually, thinking more specifically about Latin America, is honestly, our currencies have not done that badly. They really haven't.
That was going to be my next point.
If you think about the fact that the Fed has raised rates to 240 basis points, we didn't have a taper tantrum like in 2013. EM, LATAM actually behaved okay. We have this global recession angst, and yet our currencies are not too much weaker versus where they were back in June before some of this angst built. So I think that positive carry, that interest rate differential, those more proactive central banks in our region is helping stem some of the outflows you would have normally seen in this scenario. I think it also helps other things, that commodity prices are higher. So that's a very different scenario for our region than in other moments when commodity prices were falling. And then I also think there's been some other improvements like improving current account deficits, lowering external debt. So it actually hasn't been that bad of a scenario. One thing I'll say is if honestly clients already have a lot of exposure in Latin America, right? If they're already based there, their income is in that currency. A lot of their other investments probably are local in that currency as well. There's always a value of having a strong currency like the dollar or the Swiss franc or even the yen, just to diversify some of that more local exposure and local risk, right? Our region individual countries are going through a lot as well. And at any moment, the attention ends up turning back to what's happening locally, Chile being a great example here. So always important to
this is literally like a pick your poison in terms of what kind of turmoil you want to see like being materialized in the region? Like, do you want to see a political turmoil? Do you want to see protests? Do you want to see like social activism, to say it in, like, for the lack of a better word, just stemming out of it? So I completely agree with your take that the best thing that a Latin American investor can do is to try and diversify to stronger currencies.
And it's going to be, by the way, I know everyone loves to try to time FX, and it's also impossible, especially when we have such volatile currencies in LATAM. Like 3 days later, it can be a dramatically different scenario.
Well, look at the Chilean peso just after the referendum. I mean,
exactly. So I know it's tempting to play that game of, yes, I get I should diversify to a stronger currency, but let me just wait for a great moment. So it's kind of the same message we give about the stock market. If you miss the worst days, you end up missing the best days, and then your actual return ends up being half of what it is in theory. So the better thing to do is just to build that exposure that you want to have throughout time.
Yeah, patience is one of the best virtues in investing, as someone I can't remember who tends to say. Then one last question before I turn to questions of the audience. And then this is completely switching gears from Latin America to China. We all have been witnesses of China's zero COVID policy and how that has impacted in terms of international trade, in terms of manufacturing, in terms of shortages here and everywhere around the world. So do you believe that China will at some point abandon its zero COVID policy, or do you think that this is something that is here to stay?
So I hope it's not here to stay forever. I think eventually they got to move on from this. I think they know that because zero COVID is the strategy is very much weighing on their economy, not just when you lock something down, activity doesn't happen, but more generally, it's weighing on their economy by weighing on confidence. Right? Households are not, even in places where they can move around, they're not spending as much because they're worried about when the next lockdown is and their job and their salary. Businesses also are, especially if you're a small, medium-sized business, you're worried about the revenue you're going to be able to generate. So it's just a big weight on the economy. With that said, zero COVID is not paralyzing China's economy anymore. They're becoming slightly more strategic about it. So China is one of the only places where you actually have economic momentum reaccelerating. It's just more a conversation about how much can it really pick up speed if there is this confidence drag. So in terms of when they can more meaningfully change strategy and just kind of learn to live with the virus like us, we don't think it'll happen until after the National People's Congress, which was scheduled for October 16th now. That's that big vote the Chinese Communist Party does for the top leadership of the party. So the 10 members of the Politburo, which includes the president of the Communist Party and the president of China, Xi Jinping. It's just a very politically tense moment right now. There's no way to abandon the strategy that especially Xi Jinping championed so much ahead of that. So if anything, this would be for something later in the year, early next year. And meanwhile, they're kind of preparing themselves by developing their own mRNA vaccine, vaccinating the elderly more with the vaccines they have, acquiring the oral antiviral treatments and building more hospitals. But I think if, we talk a lot about things that can go wrong, black swans, I think China changing strategies on COVID is really a potential white swan here. Things can go right. And investing specifically in China, we think is very much a long-term play, a really important asset class to build exposure to, and one that we're even closer to seeing the turning point for, and actually one of the only regions we think about overweighting at this point.
That's pretty fair. So I have a couple of questions from the audience.
Rapid fire in the last couple of minutes.
No, it's not rapid fire. It's not rapid fire. So staying in Asia and considering the fact that you highlighted this specific currency as one that was behaving differently than the rest, what is your general take in Japan?
Yeah, so I think Economically speaking, Japan's doing fine. Actually, it unlike China abandoned zero COVID. So its domestic economy is really set to reaccelerate later in the year. I think its currency specifically is just being weighed down by the interest rate differential. Inflation is just not really changing around all that much in Japan, and we don't expect rate hikes anytime soon. When it comes to the Japanese equity market, the thing is, it's not really exposed to what's happening in Japan. Though these are companies that are much more exposed to what's happening globally, especially around trade of goods. And that's where the Japanese equity market is very cyclical, very dependent on global goods demand. So it's not really the best environment. In Japan, the really approach we found that works is much more focusing on just pure best ideas, active management, companies that are more small, medium-sized, that have nothing to do with old Japan. They're much more innovative. They're focused on robotics, or they're focused on different markets like the tourist activity in China. That's really the approach we found that works there.
Okay, that's pretty interesting.
I think we have time for one more question in the last minute.
Yeah. Okay, so this is a rapid fire. How do you see that the 10-year will close this 2022?
So I think it probably already touched the peak, which was 3.5. And I think it kind of just keeps oscillating in this range. When there's more optimism about a soft landing, it gets a little bit closer to 3.25 to 3.5. And then when there's that recession fear, it comes all the way down, as we saw back in May, June. It can touch as low as 2.7. So it kind of oscillates in that range, depending on how global growth fears or optimism is building. And that's why we feel like the short end of the curve is reacting to the Fed. The long end, 10-year, 30 years, is reacting more to recession fears. And that's where adding duration is actually interesting again as a recession hedge.
That's a very interesting take. Do we have time for one small question?
I think I need to run to another call.
It's okay.
Unfortunately.
No, I mean, I guess we'll have to circle back those questions to you at another point. But thank you, Gabriela, so much for
having me
your
on
time with us and for answering this chat that ended up being a rapid fire session. But thank you so much. And
thank you,
everyone who participated. I hope you have a good afternoon.
Thank you.